So we give our money away to some broker. We put it in some mutual fund. We just have it deducted from our 401k. We don't ever look at it again. We don't open the statements and we're like, hey, we lost money. Or maybe, we don't open the statements because we're terrified to see how much money we lost. And so if that is you, that's not meeting your needs. My policy grew every single day through all of this. My policy is never going to go down. Anytime we've had a downturn in the last 14 years, my policy is good. My policy just keeps growing every single day because it's not tied to the market. Hello, and welcome back to the podcast. Thank you very much for being here. Okay, today we are going to talk about what is happening in the market and the fact that at the time of this recording, August 6th, 2024, we had a huge market downturn. Everybody is expecting the economy to tank, which, that's been happening for a while, in my opinion. There's different people that talk about it, but people just are not able to afford things, right? Inflation is killing people. We've run out of COVID money. And so there's a lot of things that are causing this. However, the market tanked. Everybody is sort of in an uproar about their money. So let's talk about why the infinite banking concept shines in all of this. And really, when we get into the concept piece of this, Nelson talks about controlling your money. Nelson talks about liquidity of money. We have guarantees that he wants. He says, hey, you should have a product that's guaranteed and pays dividends. You're part owner of the company, right? And you should have a tailwind, not a headwind, because you can go places faster. Then he talks about Willie Sutton. Where do people keep the gold? And Parkinson's law and all of these things. This is all what is coming into play and what is happening right now. I'm going to break it down to liquidity, control, and guarantees because I believe it just really comes down to three simple things. And we can see that those three simple things are not what happened again in this market downturn. And what we are kind of led to believe and fed in our heads. And so when we look at the concept, Nelson is really taking us outside of what we know. Nelson is really taking us outside of what we know and what we hear as the noise and saying that is not true. You have to stop looking at that. Step aside and rationalize what is happening. So what happens is society says you put your money in a 401k or you put your money in an IRA and you essentially gamble with that money. You're going to lose some, you're going to win some. It's okay. Right? But if you are somebody that does not like to go to the casino, like myself, I will not lose money. I am not okay with that at all. It is not fun in any way, shape, or form. That is not entertainment for me. And so if I'm not going to go to the casino and I work really hard for my money and my brain says, why don't you take that money that you have made and turn it into something that creates cash flow? If I take my money to the casino, where is that creating cash flow? It's not, right? I might make some, I might lose some. Now, if I put my money in an IRA or if I put my money in a 401k or if I put my money anywhere in the market, I saw somebody on TikTok, a market guy, say everything lost money. I don't know exactly what that means, but he's like, everything lost money. I lost money in everything. And so if everything came down, that we gambled with our money, right? That did not create any kind of cash flow. I want my money working for me. So what happens is we don't have control. So number one, we lost control of that money. We have no guarantees. So we gave our money to somebody else that's supposed to be managing it. Then we get mad that they don't manage it correctly. Okay, we can't expect somebody else. It's like giving your child to someone else and saying, hey, why don't you raise them? And then you don't tell them how you want them raised, right? Because you don't know anything about raising kids. So you just give your kids away and then they come back and they're complete brats and you wonder why they're brats. Well, because you didn't give instruction. You picked the wrong person to raise the kids, whatever that might be. So we give our money away to some broker. We put it in some mutual fund. We just have it deducted from our 401k. We don't ever look at it again. We don't open the statements and we're like, hey, we lost money. Or maybe, we don't open the statements because we're terrified to see how much money we lost. And so if that is you, that's not meeting your needs, right? My policy grew every single day through all of this. My policy is never going to go down. Anytime we've had a downturn in the last 14 years, my policy is good. My policy just keeps growing every single day because it's not tied to the market. And so when we're putting those things inside of some sort of investment that's tied to the market, we're going to have these ups and downs. But society is letting us believe we don't need control. We don't need guarantees. It's okay. If you want a big rate of return, just take the risk because it will come back. Everybody's being told, oh, it's going to come back. It's going to come back. But what's Warren Buffett doing? He's selling shit like crazy, right? That's what I've seen online is he's selling stuff like crazy, but you're told to hang in there. It's going to come back. And so that's 3 parts of what we're talking about. I said liquidity, control, and guarantees. So control, you have none. Guarantees, there aren't any. If you ask a financial advisor, where are my guarantees? Because when I have a client that wants a life insurance policy and they go to their financial advisor and their financial advisor says, well, I can make you a better rate of return, I just kindly say, is that guaranteed? And the advisor will always say, nope, I can't guarantee that. That's a silly question. No, really, it's not a silly question. Because if we use the life insurance policy whole life that pays dividends, we have a guaranteed growth inside that policy. Is it a set rate of return? Nope, it's a formula. Everybody's is going to be different based on when you're going to die. But it is a guaranteed return. Dividends are not guaranteed, but they've been paid for over 100 years. Various companies, 130 years, 146 years, 200 years, just depends on the company. They have always been paid. Where are we getting dividends in the market? S&P 500 with dividends? Okay. Are they paid every single year? It's going to depend on the economy. It's going to depend on the company. Those probably aren't going to get paid every single year, and they probably have not got paid for over 200 years. I have not looked at that. However, there are no guarantees. If you are like me and you do not like losing money, then why do we have money in the market? And then we have these fluctuations and we get mad. And then they tell us, oh, you just hang in there, it's going to come back. So I ran some numbers for you. If you lose 20% in the market, you need to make 25% to get back to break even. If you lose 30% in the market, you need to make 42.86% to get to break even. If you lose 50% if you lose 40% in the market, you need to make 66.67% to get back to break even. So I want you to think about this. If you lost 20% or 30%, let's just say you lost 30% in the market yesterday, you need to make 42.86 to get to break even. And why is that? Because your money started up here and now it reduced. You are now starting from a lower point to get back to where you were. You don't have the same amount of money compounding. And this compounding BS, what was compounding on Friday and Monday while the market's crashing? Nothing is compounding. We had interrupted compound interest. That's the whole piece of everything that's happening here. In the life insurance policy, we have uninterrupted compound interest that is guaranteed. We have interrupted so-called compound interest inside of our investment. And so if we're starting at a lower point, we have to earn more to get to break even. What happens in that time? You're still contributing to your IRAs and your 401ks, and you say, oh, I got to break even already. Already? You cannot figure what has been contributed from your employer or yourself. If we just did not contribute, how long would it take? Because you can't be part of the 42% to make this back up. And so we've got these huge ups and downs that we have to think about what's happening. Okay, so that's control, and those are guarantees. You have no control of it because you gave the money to somebody else. You have no control of the market. Somebody else is controlling it. You also don't have control of when you want to take it out. You don't have control of at 72 and a half, you have to take it out. So you have to follow somebody else's rules. Now, the one piece we haven't talked about yet is liquidity of money. And so at what point are our IRAs and 401ks liquid? They're not. Through our lifetime, we're putting money there and we have to wait till we're 59 and a half. And these investments are not creating any kind of cash flow during that time. So while we have children, while we have house payments, while we're trying to live life and be young and do things, guess what? We are struggling financially and we don't have liquidity of any of that money. Yet, again, where the infinite banking concept shines is Nelson says, let's give you liquidity of money. Let's give you control of money. So we can, and then you're still going to have the guarantees, even while you're borrowing against your policy. And so I have liquidity of my money. My money is growing every single day. But right now, if the real estate market is crashing, or not crashing, but it's going down, if the real estate market is going down, I can come in and swoop up a house and with a good deal, right? Or I could come in and buy a business and turn around a business with my money because it's liquid. And so we have to look at all of those things. When the market is crashing, most people want to get out on the low. And then they tell you, hey, you hang in there. Hang in there. You should be buying stuff right now. It's on sale. With what? They just lost your money. What am I supposed to be buying stuff with? The financial advisors that I listen to in these kinds of situations, bonds have gone up is what I heard yesterday. So supposedly everybody moved to bonds and they sold out of their investment and they moved everything to bonds. If that's the case, those people are super good. They're secure. They're going to have a guaranteed growth. They're not going to have liquidity, but they're going to have guaranteed growth. They're not going to have dividends, but they're going to have guaranteed growth. And so when we are looking at the infinite banking concept, most of you listening to this are going to say, I need to schedule an appointment with Mary Jo. And then the market's going to come back and you're going to see all the bright stars and everything is going to be super amazing because now all of a sudden you've got this 27% rate of return. That's what I heard 2 weeks ago. Well, Mary Jo, I have an investment that's making me 27%. I said, I don't care what your investment is making you today. And then as I was on social media last night, I heard an investment guy say, you are in this for the long haul. Being in an investment is like watching paint dry. That is how you should think of it. Really? Because isn't that what we talk about with a whole life insurance policy? It's a long-term thought process. The difference is mine is guaranteed, mine is liquid, and I have control of it. I can borrow against that. I can pay it back whenever I want. There's no stipulations on age. There's no tax implications if I'm borrowing the money. If you withdraw it, that's a different story, whole different podcast. But if you're borrowing against it, there's no income tax implications. And so you have to weigh all of those things out. So many people read my book and then they read Nelson's book, or one of the other. And then what do they want? Some sort of rate of return answer. It is not about a rate of return. It is about liquidity control and guarantees, which is what we just discussed for the last 15 minutes, right? That's what it's about. People are missing the first half of my book. They're missing the first half of Nelson's book. We didn't write that just to fill up pages. I got an email yesterday from somebody that said, so-and-so came to me. I don't know this person, must bought a book from me. So-and-so came to me and he wants me to write a life insurance policy for him. What companies do you write with so I can do that for him? What? If you are coming to me asking me how to structure a policy, what companies to write with, that means you have done zero due diligence as a life insurance agent. You aren't serving your client. You think you're serving your client by sending me an email asking me how to do the job? Go read the damn book. If you are a financial advisor and you think you should email me, you're lucky. You are lucky that I even respond, and I respond kindly. You listen to this, you'll see that it took a lot of effort because you are not helping your client. If you are the client and you read the book and you go to your financial advisor or you go to your life insurance agent and they do not ask to read the book and they just want to sell you a policy, you are as much to blame as they are because you are not taking your money seriously. They don't understand the concept. And if we understood the concept, we frankly would not even be in the market because there is no liquidity there. There is no control there. There is no guarantees there. And then when we're in the market, we forget so quickly that we just had a 30% loss and now we need a 42% gain. And guess what? We're like, oh my God, it's fantastic. I just made 30%. I'm back to break even. But probably 10% of that is what I put in. People, sit back and look at the concept. I was trying really hard not to get have some German passion here. But it is so frustrating when all we talk about is a rate of return, and then we think that we have to lose control. We think that we should not have guarantees. We think it is okay to put our money somewhere that we are saving for retirement. And all we're doing is gambling with our retirement. It is 100% a gamble. And we are not looking at that. We are not paying attention to it. And we think it's just okay. It is not okay. It would not be okay if you gave your money to me and I said, you know what? I'm just going to see what kind of mood I'm in if I'm going to give that back to you. What? That's just gambling. That's just hoping somebody gives you your money back and maybe a little something, right? The concept, this is such a good indicator of why we do infinite banking, of everything that Nelson and I talk about. Parkinson's law, Willie Sutton's law, headwinds and tailwinds, all the stuff that most people ignore in the book. If you have Becoming Your Own Banker, go back and read. Skip the numbers. I don't even read the numbers in Nelson's book. I read the first half of the book. Skip the numbers. Read the first half of the book and then go back and reread the first half of the book. And if you still have questions, then email me on the first half of the book and stop asking me about rates of return. Stop asking me about how fast we can get money into a policy and how fast we can use the money through the policy. Those are legit questions when you understand why you're doing what you're doing. It is not about a rate of return. It is about liquidity, control, and guarantees. And we are accepting the fact that, it's just not going to happen. Yes, it can happen. Yes, it can. It's like accepting the fact that, oh, you know what? You're just going to be unhealthy your entire life. You don't ever have to worry about being healthy because it's not an option. Really? There are alternatives to absolutely everything we do. And we have to start looking for them and paying attention to it all. All right. I will get off my soapbox because I really wanted to not have some German passion in there today. And I wanted to just stay calm and cool. But y'all know me, and that's not how I operate. Anyway, if you have not gotten Becoming Your Own Banker, go and get that book. Go to withoutthebank.com, grab that book, grab my Life Without the Bank book, schedule your appointment. I am booked out until November. Get your book. You'll get a link to my calendar. Get on the calendar, read the book, and then we will visit. If you have questions, comments, whatever, in the meantime, email me, maryjo@withoutthebank.com. I am happy to answer those questions, even though you might be putting the cart before the horse. And here's the other thing. Please finish reading the book before you email me. I am getting a lot of emails, which again, I appreciate your emails, but I am answering stuff that is in the book, but you're emailing me because you're so excited. And so you're emailing me before you finish reading the book or before you read Nelson's book. All the answers are there, you guys. And so if you just wait until the end or listen to a few podcasts, then you're going to get your answers. So with all that being said, do email if you have a policy you need me to look at. If you are an agent, if you have not read the book, don't email me. Just don't. Save yourself the time. Save me the time of answering you. Because if you have not read Becoming Your Own Banker, then why are you emailing me? Do your own due diligence. I did. I didn't go to somebody else and say, hey, teach me everything you know, because I don't want to read. Do your clients a service and read the book. Okay, you guys, if you would be willing to rate this on Google Play or Spotify, that would be absolutely fantastic. I would appreciate that. If you want to share it, I would appreciate that as well. All right. Hopefully you liked this. Hopefully you got something out of it. I appreciate you, and you have a fantastic rest of your day.